Hey, good morning, everybody, and welcome to another Mortgage Coach Tuesday interview. My name is Dave Savage. I am the CEO of Mortgage Coach. If you have not already, make sure you connect with me personally and with our company on Facebook, LinkedIn. This call will be recorded and it will be uploaded into our YouTube channel. And hopefully all you Mortgage Coach members on today's call, you've already downloaded all of our apps. I do want to mention that last week's call with Sarah, we did have some technical difficulties, as many of you know. That call has been rescheduled for October 16th at 9 o'clock. Hopefully you're getting an email from us, with the monthly calendar, and you already know that. If you're not getting this email, check your spam filter. That you may have us going into spam, or you may need to email support@Mortgage Coach. So we are literally a week away from Sales Mastery. I'm going to be there. Please come see me, come see our team. We've got some great guests on today's call that are also going to be at Sales Mastery and actually speakers at Sales Mastery. But reach out to me. Make sure we connect at Sales Mastery next week. And obviously, Sarah and I will be recording live from Sales Mastery next week. Well, today is all about TRID. It's a TRID panel. We've got 4 amazing guests. I'm going to start with the introduction of Richard Horn. Rich, thanks for taking time to bring leadership to the Mortgage Coach community.
My pleasure, and thanks for the opportunity to join you on this webinar.
Well, the call we did several weeks ago is still trending. I looked at our YouTube results, and it's still one of the most watched videos. So I think it's over 200, it might be over 300 views. So thanks for creating content and bringing this kind of value to the industry.
I'm glad to help educate the industry about TRID. It's such a major change. That I think it does deserve a lot of discussion, and thank you for bringing that discussion to your audience.
Good. Well, I look forward to keeping this going. I also have 3 great loan officers and leaders. So Sean is both a producer. He also coaches a number of top mortgage professionals at RPM. Sean, welcome to the call. Look forward to having you on today's call.
Yeah, thanks for having me. I'm looking forward to it.
Yeah, so everybody, Sean also created an awesome Mortgage Coach TCA that he really made for realtors. So I have put a link to that in chat, and he will be sharing his strategy with how he's communicating with realtors and how he's recommending to the loan officers that he coaches and leads how they communicate. We've also got Dan Keller. I mean, I've had Dan Keller on a call like this more times than I know, and Dan, I know you're also one of the speakers at Sales Mastery, but thanks for making time.
I appreciate you having me, Dave.
So, hey, Dan, real quick, just so everybody has kind of some idea of the kind of production you're doing as an originator, how many families are you talking to per month, and how many families are you helping get into a mortgage on a monthly basis?
Yeah, this year we're on track to help over 120 families purchase or refinance. So anywhere between 10 and 15 a month. Okay, fantastic. How many are you talking to, when you think of the amount of education that you're providing in the industry? Yeah, it's probably, without pulling out my lead tracker right now, it's in excess of probably 60 to 80 families a month, leads a month that we're talking to. Good. So a lot of education going on, and Dan's going to bring some of that into today's conversation and tell you how he's preparing for TRID. We also have Danny. I've had Danny as a guest more times than I can count, and he's always bringing lots of value to the Mortgage Coach community. Danny, you're going to be also speaking at Sales Mastery. If you could, provide a little framing and then also answer the same question I asked Dan.
I'm really excited to be here and also to be speaking at Sales Mastery. My team and I are on track this year. Our goal is to hit 500 families with either purchase or refinance help. So we're trending a little bit over 40 a month, and it does look like we're going to be on track to hit that unit goal. So it's super exciting.
That's huge, and they're in the San Diego market. So we're talking to one of the most elite teams in the country. And Danny, looking forward to hearing how you're educating families and helping. So, folks, this is going to be a panel. I will be opening up for Q&A throughout the call. While we do have some planned questions that we're going to kick things off with, your questions are going to get looked at. They're either going to be looked at me or someone moderating today's call. So make sure you're familiar with your GoToMeeting control panel. There's a place for you to submit questions. There are handouts that we'll be posting throughout the call that you can download that are tools and resources for you. And of course, there's a little chat window. So I just want to make sure you're using that throughout the call. Also want to make sure everybody knows that we are going to be doing the Mortgage Coach Total Cost Analysis TRID training this Thursday at 9 a.m. Pacific. And we'll be doing this all month. You know, it's all about preparing our members to have a competitive advantage every time they go up to bat to help a family and to do it in a way that's a competitive advantage for realtors. So I also want to thank all you members that have been forwarding me great pictures of Mortgage Coach, educating people out in the real world. This was submitted from Robert Ring a couple weeks ago, a first-time home buyer in a coffee shop. Robert also submitted a great picture while he was educating a realtor in a realtor office. Hopefully everybody was on that call that we did with Jay Crowell a few weeks ago, and he walked us through how he's educating families when they come into his office. And again, I just keep getting these pictures. So please continue to forward me pictures of Mortgage Coach out there in the real world. This is Scott Cummings in Albuquerque, New Mexico, educating a realtor and helping them understand, how mortgages can help families. So Jeremy Forcier, I could go on and on, but please forward these pictures to me as you're out helping families. So let's start things off. Rich, I know you have lots of the top lenders as clients. Given the fact that you were with the CFPB and one of the leaders of TRID, if you could, one, just give a little bit on your backstory, and then let's just start with, what are the most relevant questions that you're hearing over the past few days?
Yeah, that's great. My backstory is that I started at the CFPB in January 2011 when this rule actually started, when the Bureau was just a team at the Treasury Department that was helping to create the CFPB. That's when I joined up and actually started working on this rule. So from January 2011 to just a couple days ago when the rule is effective, that's how long it took to create these forms and actually have them out in the marketplace. I ended up leading the design and consumer testing of the disclosures. So consumer testing, it was a tool that we used to ensure that consumers could actually understand the prototype disclosures that we were creating in the office. We would actually sit real consumers in front of our prototypes around the country and have them work through fake loans using our prototype disclosures, and we would see what worked and didn't work and then go back into the office and make the changes based on what we saw in consumer testing. And so that's one of the reasons why these forms, I think, have been so well received by the public, including industry, is because of all the efforts that went into designing them and all the consumer testing that we did. We did in total about 17 rounds of consumer testing and an extensive quantitative test with consumers all around the country, and that amount of work really, I think paid off. I think these forms will be more understandable to consumers. I think that they will help loan officers build trust with their customers, because consumers will pretty easily see from the disclosures that they're getting what the loan officer told them that they were getting. And if they have any questions, they'll be easy to discuss with the loan officer, I believe, because the forms are easy to understand. So they'll be able to frame their questions in language that they get, that they understand. I also ended up leading the final TRID rule. So not only did I lead the design and consumer testing of the forms, but actually led the drafting of all the rules underlying the forms, when they have to be provided, who has to provide them, what the liability is for them. Those are important facets of this rule for folks in compliance. I think loan officers tend to want to just understand how a consumer is going to interact with the disclosure, but there are actually a lot of requirements that were put in place about the timing of them, when you're obligated to provide them, and who provides them. So I know, Dave, that's something that you wanted to discuss on this call, and your first question is a great one. What's a loan officer relevant question that I've gotten? Well, being a compliance attorney, I think that there's one question that stands out as an intersection between what loan officers want to know and what compliance folks want to know, and that's can I still do pre-approvals and pre-quals under the TRID rules? There's been some misinformation out there since the rule was issued that those are prohibited, because this rule does redefine the definition of what's an application. It redefines it to include just 6 items that are part of the current definition, and it doesn't allow lenders to create their own definition, so to add additional items to that definition. It's just 6 items, which is the name, the property address, the estimate of the value of the property, the mortgage loan amount sought, the borrower's income, and social security number to obtain a credit report. That's it. Once you have those 6 items, you have an application. You can't ask for anything else, or require, excuse me, you can't require anything else as a condition to providing the initial disclosures, the loan estimate. And so a lot of loan officers said, well, you know, can I still do a pre-approval or a pre-qual, considering that there's this new restricted definition of application? And the answer is yes. You can still provide pre-approval or pre-qual, and if you do not have the property address yet, you do not have an obligation to provide the loan estimate. You can use an initial worksheet, which estimates what the closing costs might be and gives the consumer an idea of what their loan terms might be in addition to that pre-approval. That is completely permissible under the rule, but there are a couple things you have to keep in mind when you're doing this. One is that any worksheets that you provide to a consumer before you provide a loan estimate have to include a disclaimer at the top, and your shop should have done this for you already. It should be in your LOS systems or your doc provider systems. The addition of a disclaimer up the top that says your rate, payments can change, get an official loan estimate. That disclaimer is required under the TRID rule to really make sure a consumer knows that that worksheet is not the official loan estimate, that it doesn't come with the same accuracy standards and reliability that the loan estimate does. Also, that worksheet cannot look like a loan estimate or a closing disclosure. It seems counterintuitive because, as I mentioned before, the loan estimate and closing disclosure were designed with the consumer in mind to make sure it was understandable, but the worksheet can't look like it. And the reason is that in the rule, we wanted to make sure that consumers really didn't misunderstand that the worksheet was a loan estimate, that they didn't confuse the two. So that's one way to reduce that risk, is by prohibiting the worksheet from looking like the loan estimate. The other thing to keep in mind when doing this is that you cannot require verifying information as a condition to provide the loan estimate. That's prohibited under current rules, and it's still prohibited under TRID. What that means is that when you're doing a pre-approval, it has to be completely voluntary, the provision of additional verifying information, so bank statements, W-2s, those kinds of things. They need to be provided voluntarily by the consumer, and you want to be able to demonstrate that. So a lot of lenders are thinking about creating an acknowledgement page that that documents that the consumer is providing that information voluntarily. I would also try and avoid any misrepresentations or any implicit communications that information is required as a condition of just getting a loan estimate. So there's a couple things that you want to keep in mind, but pre-quals and pre-approvals are still permissible under the rule.
Beautiful. So by the way, the questions are just pouring in, and while we have about 8 to 10 questions that we plan to ask you, I am going to just start integrating what's coming from GoToMeeting. So folks, feel free to add those questions. Danny, do you have any color or any questions to ask Rich, just representing, you know, an originator? Anything come to mind after hearing what Rich said, or a question? By the way, Danny, we can't hear you. If you're either muted or you're not on the
Oh, there we go. Had my mute on. Apologize about that. So the first thought that popped into mind was just kind of the idea that we were talking about earlier or late last week, that, you know, previous to the loan estimate and the closing disclosure, there really wasn't a tool that was aligned as well with the Mortgage Coach total cost analysis as far as providing that kind of initial estimate to a client that also included a cost over time. So as you know, Rich is going through his commentary about, you know, giving information to clients in advance and in that pre-approval stage, I think everybody on this call is, for the most part, already using the total cost analysis to implement that. So that seems like it would actually align really well with what he's saying here.
Yeah, no doubt about that. So, hey, Rich, one of the questions that just came in, you know, which is not surprising, it came in from Jill. So, Jill, thank you for submitting it. Her question is, please be sure to ask Rich how TIP is supposed to help the customer, and how to calculate it. I just don't know what to tell the borrower in terms of how it helps them. So, how would you? I mean, I have some responses to that, Rich, but how would you answer that?
Yeah, that's a great question. It's something that we've talked about offline a lot, and so I think it's not surprising that question's coming up from your audience. The TIP is probably the one part of the loan estimate that I think is most likely to raise questions from consumers. I think the reason is that the percentage amount is going to be so high and so different from the other percentage amounts on the form that it'll really stand out. The reason it's on the form, I think we talked about this last time, is because Congress added it to the TILA disclosure requirements, and so we had to integrate it with the other disclosures into the loan estimate. It's a statutory requirement. There was really no way around it. We consumer tested it to try and make it as understandable as possible. And in consumer testing, consumers generally understood that a lower tip was better, and that is because it's essentially, and this is the descriptor that's used for it, it's the total amount of interest that the consumer will pay over the life of the loan as a percentage of the loan amount. And I think when consumers read that's the total amount of interest, they know paying less interest is better, and so they wanted to see a lower percentage amount. So I think that even for the participants in consumer testing that were lower financial education, lower education generally, they did still generally understand that the lower tip amount would be better. How to describe it to a consumer, I think that you want to achieve two things. One is explain the concept to them that this basically totals up every single interest payment that they'll pay over the 30-year loan term, or whatever loan term you're presenting to a consumer, and then adds up that huge number and divides it by the principal amount. And so that's a good way to describe it to a consumer. I think that trying to explain why the percentage is so high, I think that's going to be the more difficult thing to do, but also I think it's probably something that you want to try and achieve to lower consumers' I guess anxiety about that high number. I don't know, Dave, if you have any thoughts about that. I know you've been thinking about this for a while as well.
Yeah, well, I'm gonna walk everybody through what came out of a call I had with Jeremy Forcier a few weeks ago, and then I would like every loan officer to go around and provide your framing. So each of you, I'm going to call on, let's see, I'll call on Dan first. So Dan, be ready, then Danny, and then Sean. Because I do think this is a big one, but this is what Jeremy and I came up with a few weeks ago, that the CFPB wants to make sure 2007 never happens again, and that when a family gets into mortgage debt, they really understand it. TIP helps make the importance of the mortgage decision even more clear and valuable. TIP helps you see how expensive a mortgage can be and how important the mortgage decision can be to building wealth with real estate. You know, and then kind of going on, TIP and total cost over 5 years helps a family make an important decision. So, you know, to add some color to that, I mean, everybody needs to have their, you know, what's right for you, but at the end of the day, you know, we can all say that whether we think that's a great number or not, doesn't matter. That's what it is. Let's make the best of it. And there's no doubt that it really helps make the point with the family that a mortgage is expensive, and a little change in rate can really throw up that cost over time. And so this metric, at least in my opinion, there's no better metric than to make that point really crystal clear. So why don't we go around, and Dan, why don't you provide some color around this, and let's go, each one of you, try to do it within a minute, no longer than 2 minutes, and then we'll keep going. Dan?
Yeah, Dave, can you hear me?
We can.
Okay, one of the approaches that I'm taking with my real estate agents and my team is much like what Jeremy said, is the CFPB wants to make sure that today's borrowers understand the total and true costs of getting a mortgage. So they understand all the fees and how the fees relate to the rate. And then as far as TIP is concerned, kind of what I'm using, these new loan estimate disclosures, I think they're positive. So I'm selling the positive aspect of it to my agents and my clients, such that for me, it's taking the focus off of just getting beat up over a small difference in rate and a small difference in fees, and focusing on the total cost. So as it relates to TIP, looking at a 30-year versus a 25-year, a 25-year versus a 20, or a 30 compared to a 20, and down. So, and that's where Mortgage Coach comes into play. I mean, that's how I'm leveraging, and it's just right there. And so I can show that to my clients, I can show that to the agents, and let them know that we're kind of already using that talk track in our presentations.
Beautiful, beautiful. So Sean, I know you've got a lot to speak to this, and we're going to showcase the video in a I'd say in probably about 10 minutes. I'll bring you in and have you walk through how you're telling this to realtors. But anything you have to add to this, and how loan officers should be talking about TIP?
Yeah, for me, it's again, I think anyone who's on this call, you're probably already using total cost analysis, and none of us have really been hiding from the fact that a mortgage costs money. And I'm pretty sure when they finance a car, there's interest. It costs money to borrow money. So I look at the Truth in Lending, and it shows, $1 million loan, you're going to have $800,000 in interest. It showed us a dollar amount. So I really I'm very curious to see how the consumer reacts to TIP, because I just don't think it's really that big of a deal. And what you guys will see later in that video is my approach to TIP is to show how cheap money is right now compared to what it's been historically. So I love the new forms. I think they do provide clarity. I'm not excited about everything to do with TRID, but as far as TIP goes, I don't think it's really that. I'm very curious to see if it comes up as a big talking point or not.
Now, real quick, Sean, I think this is a question that a lot of loan officers have, is are you going to talk about it before you give the LE, so that you've already educated the family and it's not a surprise, or are you going to give the LE and see who asks you about it?
Oh, no, absolutely. I've been out. I've probably spoken, presented to over 200 real estate agents now, and the slide you guys will see in that video is their favorite slide, just historically showing what TIP is. But proactive is always better than reactive. If I show them, then it's not me hiding anything from them. So I'd rather address it up front. And I've got, I'm going on tour today. I've got 5 total cost analysis in my hand. And I love the new format where it shows the first lien TIP. It's got the first lien 5-year cost right after. There's nothing for us to hide from. It's really easy to explain, in my opinion.
Right on. I agreed. Danny, any thoughts that you have to answer this for the community?
I'm actually really excited about the TIP conversations, because I think all of our goal is really to educate our clients to help them make better decisions, and seeing that big number really drives the conversation, or sharing that with them in advance, and allows us to give the truth behind it, which is, yes, there's a cost associated with borrowing, but there's a tremendous benefit as well. And I think Sean's point that money is so cheap right now, we can talk about things like the cost of money over time, and the opportunity cost that comes with, the alternatives, which is putting money into the houses in the form of greater down payment versus borrowing it. So it really, I think, leads us into the benefits conversation and the conversation about opportunity that comes with borrowing by, starting off with, hey, this is how much you're going to pay, but here's what you're getting for that money. Nobody wants to believe they're getting a cost without a benefit, and now we have this great tool that we can use to lead into that conversation.
Love it. Richard, before we bring in another question, anything you want to add after hearing what the mortgage professionals and loan officers had to say?
Yeah, I heard a focus on the time value of money and the benefits that you get, and I think that those are two things that could help the conversation to explain that this is an amount of interest that's paid over 30 years of the loan term or whatever the loan term is, and so the number looks very high, but think about what you're getting every single one of those 30 years, the opportunity to be in that home for the interest rate you got that you can't afford. You know, a conversation like that I think can help explain it. But I'll leave that to the professionals who have worked with consumers face to face.
Well, the advice for Mortgage Coach is now it's more important than ever that you really work on your pre-LE conversation. You need to make sure that your clients are more educated. You need to make sure that they understand cost over 5 years. They understand TIP. You know, the more you can deliver that with graphs and charts and you can put it on their mobile device, the better off the family's going to be, the smoother the transaction will be. So it's just more important than ever that you talk about that pre-LE and they understand TIP, they understand total cost. So I think we've nailed that. So Rich, I mean, everything's blowing up. You know, I mean, I've got, you know, I mean, tons of questions. Folks keep submitting them, but you know, everybody wants to know what's going on with the black hole. Any perspective you can provide?
And I love the term that's come out of this rule for this concept. The black hole, it just gives you images of death and destruction. Hopefully it doesn't turn out that way once loans start to close, but essentially the black hole is a part of the rule that I think is not as well understood, and it really is caused by a lack of clarity from some of the regulatory provisions that hopefully the CFPB will clarify in the future. But essentially, you know, once you give the loan estimate, things will change. You can take advantage of changes that are valid, which are called change circumstances, by providing a revised loan estimate with that change on it, and then you'll be able to charge that to the consumer and not run afoul of the tolerance rules, which restrict how high costs can increase from their estimates. The rule says that you can do this, as I mentioned, by providing a revised loan estimate. It doesn't say you can do it by providing a revised closing disclosure, and as you probably know, the closing disclosure has to be received by the consumer at least 3 business days before closing, and many lenders are planning to take advantage of what's called the mailbox rule, which says that the disclosure is considered received 3 days after it's sent, so they're planning on sending it out 6 business days before closing. So that's potentially 6 business days where under just the regulatory text, you're essentially not allowed to take advantage of valid change circumstances, and you're not allowed to increase your charges to the consumer. But there is a commentary provision in the rule that some have missed, some don't understand that it's there, some don't understand the wording of it. But there is a commentary provision that says you can put a valid change circumstance on the closing disclosure and use it for tolerance purposes. So the rule allows you to charge it to the consumer and not run afoul of the tolerance limitations if you're within a certain window before closing. Many have different interpretations of what the window is under that commentary provision, so that there's one source of confusion there. My interpretation is that it's 6 business days before closing. Which actually it's a little more complicated than that, but generally that's an easy way to describe it. So if you're 6 business days before closing, which in many cases will line up with the mailbox rule, so the day you provide the closing disclosure, you can put change circumstances on the closing disclosure and charge them to the consumer. But there are 2 instances where this black hole comes up, and I think the reason why people are calling it the black hole is because that's where, even though if you have a change circumstance that happens, it gets sucked into the black hole and you can't charge it to the consumer. And that first circumstance is if you provide the closing disclosure too early. Let's say you really want to make sure you can close, and so you say, I'm going to send out that closing disclosure 2 weeks before because I don't want to miss out on that closing date. Well, that you potentially have just caused yourself a week of not being able to increase your charges or charge increased charges to the consumer for things that occur during the week during the first week after you send out that closing disclosure, because you provided the closing disclosure too early. And it'll take you a week to get back into that 6 business day before closing window. The other time the black hole happens is when closing is delayed for some reason. Let's say it's the night before closing and there is some weather event and closing has to be delayed, or there's some damage to the property that's discovered during the walkthrough and closing has to be delayed by, let's say, 2 weeks. Well, because the window in which you're allowed to provide a revised closing disclosure is 6 business days before closing, you potentially have then 1 week until you get back within that window where you cannot use changed circumstances on the closing disclosure. It's a very complicated topic, but essentially it's something that can happen. The extent to which it does happen, we'll have to see. But it's something that also there's a lot of confusion about, and so hopefully the CFPB either amends the rule so that this black hole doesn't exist anymore, because there doesn't seem to be a reason to stick lenders with costs that are actually valid changes. I don't see a policy behind that. Why there should be a policy to do that. Also, things do happen, and there are delays in closing, and the rule should be accommodating to that, just a fact of life. And so, hopefully, there's some clarifications or amendments to the rule in the future about this. But that's essentially the black hole. It's hard to describe clearly. Hopefully, this was clear enough for your attendees.
Yeah, no, it's a complicated issue. There's lots to consider. So, by the way, I've seen a lot of, more questions and a bit of, I don't know, I'll just call it chatter around TIP, and, everything from kind of making it a joke to, hey, Congress made them do it. I just want to reemphasize, I do believe the best mortgage professionals, they're not going to roll their eyes when they talk about TIP. They're not going to refer to it in a disparaging way. They're going to be very positive. They're going to make it very simple. As a mortgage coach, they're going to make it highly visual. They're going to put it on mobile. They're going to educate. So I just want to emphasize, because I have seen a number of folks, and I know we're just having fun, and I know that, TIP was not the metric that we all love, but I really highly recommend everybody on this call, reframe, be positive, and turn it into an educational opportunity to show everyone how expensive a mortgage can be, and use it as an opportunity to, position yourself as the expert. So let's ask another question, and I'll open it up to the loan officers to add some color, and then I want to make sure Sean shares how he is delivering advice to realtors. So, Rich, this has come in from a number of folks. Now, I think this is one of those things that's kind of market relevant. I know here in the Northwest, there's been a lot of questions about how discounted title premiums should be quoted, and the fact that in some markets, that it's going to be discounted. So if you could answer this question around how they should be presented when we know that by the time it closes, it's going to be discounted. It's not going to be the full amount. Thoughts?
Yes. The rule does require a different method of disclosing lenders and owners' title insurance premiums. The reasoning behind it, the policy behind it, I believe is sound, and that is that a borrower is required to purchase a lender's policy no matter what. The optional owner's title insurance policy, the borrower can decide whether to purchase it or not. It's at their election. And so what the rule does is disclose to the borrower what the cost of the lender's title insurance policy is if they decide not to purchase an owner's title policy. And then for the owner's title policy, it discloses the marginal cost that they'll have to pay to actually owner's title insurance policy. This is different from the way lenders and owner's title insurance policies charges are filed or promulgated in the states, because usually if an owner's title insurance policy is purchased by a consumer, the discount is provided to the lender's policy, and the borrower pays a full cost for an owner's title insurance policy. This is the method on the forms is different from that, because really the one that the borrower is required to purchase is the lender's title policy. And so if a borrower decided, let's say, not to purchase the owner's title policy, on the forms they'll still know what the cost that they're required to pay for the lender's title policy will be. So that's the reasoning behind this. This is what's going to be disclosed on the loan estimate as well as the closing disclosure. And so the costs that are disclosed on the forms will not be, in many states, the actual filed or promulgated rates, as I mentioned. And so title companies, to ensure that they comply with their state statutes, are planning to provide a separate page at closing. The American Land Title Association has put out a model settlement statement that title companies can use that ALTA has approved, which does lay out the actual filed and promulgated rates and lays out the debits and credits in the closing in a way that title companies like to see it. So at closing, there will actually likely be a closing disclosure with the TRID method of disclosing lenders and owners title, and then also the ALTA settlement statement, which discloses the actual filed and promulgated rate. So there are two things to think about here. One, the loan estimate will show the borrower a marginal increase in the cost for owner's title insurance policies, and also put next to the owner's title insurance fee name a notation that says it's optional. So this may increase the amount of questions you get about owner's title insurance because it'll look cheaper, and also it'll say that it's optional, and so your customers might ask you about the benefits and the advantages and disadvantages of owner's title insurance. Also, at closing, there may be questions from customers about why the costs on the forms were different from what was actually being charged by the title insurance company. And there's one thing to keep in mind about that at closing is that the total will always be the same. The total should match up because really it's just a different way of divvying up the total cost of the simultaneous issuance of lenders and owners title insurance. So that's one thing that you can discuss with customers about this different method, is that the total is actually the same, but the reason behind the disclosure on the close disclosure is to show the consumer how much extra they had to pay for the owner's title insurance.
Got it. So folks, hopefully that helped. If you have more questions on that topic, submit them. I do want to do a shout out to our training team and design team. They have created a deliverable, a script that has both TRID scripts, that will help you answer the question around tips. So that is in the handout section of the GoToMeeting. You can download that. If you are listening to the recording of this call, there will be a link to download this 2-page script. It's got both borrower scripts as well as realtor scripts, as well as a checklist on how to make a great video. So Sean, let's bring you in. If you could just do a couple minutes, I'll walk through your video. And by the way, there's also a link to Sean's 2-minute video around how he's explaining tip to realtors. So Sean, if you wouldn't mind providing a little color around what you're doing and how you're communicating tip to realtors.
Yeah, so basically, just to give some feedback or some history of how I adopted my approach was, I went to a realtor meeting in Silicon Valley, Cash is King, and somebody just come back from an R conference. Wells Fargo was saying that finance transactions would take 60 to 70 days to close as a result of this new TRID regulation, and this was back, I think, in March of this year. And that was honestly the first time I'd really heard any real details of TRID. And this doesn't work. We're already losing to Cash. Now we're not even going to get looked at. How does this benefit the consumer? So I spent a lot of time with our organization and compliance learning about it. And when I'm approaching a real estate agent, to me I don't need to present every little detail that we as a lender have to go through. It's what's important for them to understand. What are the things their client could potentially ask about, and that's really my approach. And really what this does for me in a nutshell is again, I think a lot of the mortgage coaches on the call, we all are pretty proactive as individuals, but not every lender is. So we've always encouraged, let me know of any credits, addendums, changes up front, and it doesn't always happen. TRID to me kind of forces some more proactivity from our real estate partners. And that's really how I've approached it. You guys, we're going to work with the team. You're going to have to work with the agent on the other end of the deal more than you have before, but proactive communication really simplifies all of this for all of us. I'm going to be more proactive as a loan agent. I'm going to confirm the loan program, the loan amount, lock the interest rate. I'm going to call you guys to make sure that you've reviewed the inspection, the appraisal, there's no new addendums or credits, so I can present the closing disclosure properly. If I don't ask those questions, that's where we're going to get into that black hole period. So, you know, is it going to work perfectly every single time? No, but my goal is to minimize the amount. I have to go back and forth with, you know, and then really, so I explained to them how the 3-day wait and 3-day mailing period works. That's obviously of concern for them. That's 6 days that you guys are causing a delay on me closing. And then tip. I do think that tip is a good point, a good talking point, and you know, that's, again, if you watch that video, you guys will see how I've presented it, but it's, to me, it's real estate agents. I wish I did work on every single one of your transactions, but I don't. So when you have a lender who may not have taken the time to do all the research that I've done, when the client calls you because the lender doesn't know how to explain it, what are you going to say? And that's where I use, you know, what was the tip in 95, 2005, and what would it be today? So I really try and keep it really simple and focus on the tip and the mailing period as being their major concerns, and then just giving them the confidence that as long as we're all proactive, and I am committed to being proactive, that it's not the end of the world. This isn't doomsday like it was initially presented at the beginning of the year.
Beautiful. So if you haven't watched this 2-minute total cost video, it's just a great way where it not only teaches someone what tip is, but it puts it into context as to what it would have been in past years. So, you know, helping understand that borrowing money is expensive, but doing it today has never been cheaper. So also, I want to do a shout out. Oh, go ahead, Sean.
Well, sorry, I just saw the slide. So just so everyone knows, the slide you're looking at is based on $1 million loan amount, just because I wanted to speak to the tip. So in 95, 198%, 2005, 109%, today, 69.2%. So that's how that slide was built.
Yeah, no, beautiful. Again, for the best educational experience, make sure you watch this video. It's in chat, and it's also in on our Facebook post. So other mortgage professionals, Dan, Keller, do you have anything to add at this point? I know you've got some talking points around what you're telling realtors, how you're communicating TRID as whole. Anything you want to ask Richard, or anything you want to add?
No, I think Sean's presentation is brilliant. Something that Richard said earlier that I'm kind of leveraging is so many people are focusing, so many loan officers are focusing on buyers and the disclosures to people borrowing money, and kind of the approach I've been taking over the last 3 weeks is connecting with my agents, specifically listing agents, so that I can have a conversation with sellers and with the listing agents, because it doesn't matter how great these agents do listing a home and getting an offer time for the highest amount. You know, if the transaction ends ugly because the loan rep managing the mortgage doesn't quite understand these guideline changes, it's going to end ugly, and they're going to look ugly as a result.
Love it. Danny, anything you want to add to the conversation at this point?
I just want to thank Sean for bringing up the fact that this TRID is really going to make the whole industry better. You know, the whole idea and the energy that's been placed behind it is, I think, really got agents scared. And that message that, you know, 45 is the new 30, which is just absolute BS, it's going to give us a great opportunity, you know, the people that are really being proactive, a great opportunity to differentiate ourselves even more. And I think one main tool that we're going to be using, the whole total cost and, you know, the total interest paid, the conversation that I think that'll advance the most on the front end is the whole idea of the cost of waiting, which I think Sean's presentation really highlights. You know, if people wait 6 months, 12 months, and rates even increase, you know, a quarter to 3/8, the impact that'll have on their lives as we can, you know, show this, you know, using these new tools. It's just, you know, phenomenal the amount of leverage we can bring people if we educate them about how their decisions impact them.
Beautiful. I love what you said. If we can educate people about how their decisions impact them, and folks, TIP does accomplish that. It really puts an exclamation mark around just how expensive a mortgage is, And when you're able to do that, it puts an exclamation mark around, if you're an advisor and a teacher and an educator, just how valuable you are in the process. So Rich, I loved the newsletter that you sent out on Saturday. I'm happy and honored to be part of that group that you sent it to clients and friends. And when I read it, and I had to read it 3 times, but you talked about how it's really going to encourage customers to shop. So I kind of have 2 questions. As the guy who created, or led the creation of that project, how often do you think people are going to ask questions around tip and cost over 5 years? And how much do you think this is going to increase shopping among consumers?
Those are great questions, and I'm glad you like my my little alert that I sent out this past weekend. It's funny. October 3rd for many of my clients was a hugely important day because it was turning the switch on for TRID. But for consumers, they haven't really seen the effects of it just yet. I think with the consumers submitting an application this weekend, they hopefully will get a very clear and accurate and compliant loan estimate. But that's just going to be the start of the questions. They might get a loan estimate, have questions for the loan officer about a lot of numbers on there, and then I think we'll start to see the effects of it, of consumers really understanding their loans better. But also the CFPB has been putting out consumer information that's essentially telling consumers that they should go out and shop between 3 different lenders to get through loan estimates from 3 different lenders and shop essentially for the best rate. That's been the CFPB's message on their website, in their other materials that they provided, such as the Home Loan Toolkit. And so I think if there are consumers that are paying attention to what the CFPB is saying, that there'll be more of a tendency to begin shopping with the loan estimate. I also think one of the reasons why we tried to design it so clearly was so consumers could compare different loan offers. The design was meant to allow consumers to put the pages side by side, quickly scan them, and see the differences readily and easily. The benefit to doing that is not just for comparing loan estimates between different lenders, but also to compare different loan options at one lender. And so we were on the team that was working on the design, thinking about it in both ways. But with the CFPB's messaging, if consumers are actually paying attention to it, I think that there should be an increase in shopping. And also, because the forms are more understandable, what we saw in consumer testing was that consumers were asking more questions about what they were seeing. We're saying that they would ask more questions to the loan officer about things that they didn't understand, or if they wanted to discuss them. So I think that there could be an increase in shopping, as well as the amount of questions. And also think of it as an opportunity to be able to show consumers the different options that are available to them. If you can provide loan estimates for, let's say, a 15-year fix and a 30-year fix, the consumer will be very easy. It would be very easy for a consumer to see the differences between them, and it'd be help foster a discussion about what the best option is for them. And that's the reason why we designed the form so clearly.
Love it. Hey, so we're kind of rolling into about 12 minutes left. We've got tons of questions. Again, all month long, we're going to continue to provide leadership. Make sure you get your questions answered. This will not be the last time we do a call on this. As I mentioned, on Tuesday at 9 o'clock, it's going to be, how to deliver the TCA, the Mortgage Coach Total Cost Analysis, pre-LE, and we're going to be focusing on that from a technical standpoint. Danny, anything you want to, ask Richard as it pertains to the way he answered that question, or any color you want to provide around that from a loan officer's perspective?
I don't know if it's just me, but I feel like we're getting shopped heavily right now already, even before the total cost analysis. Before the TRID disclosures have gone out. And I mean, even my college roommate shopped me when he went to buy his place. I was like, what's going on, man? But I just think it's prevalent out there that people feel like they need to do the best thing for themselves and protect their families. But ultimately, I think the Mortgage Coach, tagline, advice not price, is really what people are looking for. ultimately they're going to make their decision based on who they feel is going to be best equipped to help their family. And if we continue to do what we're doing, really, around the whole shopping process, I don't imagine that we'll change anything about how we're approaching that and what we're saying and doing for our clients, because it's already happening now. And if it turns up 10 or 20%, I think we'll still be winning at the same degree.
Yeah, no doubt. I think what needs to go up is consistency. And I'm gonna, this is gonna be the last question. Call it formally. I'll try to bring in another question from the audience. But Richard, there is a compliance piece, and that is delivering a consistent experience to families. We want to make sure the Smith family is quoted rates and treated the same way as any other family. One family who barely qualifies for an FHA shouldn't get treated differently than the customer who's doing a jumbo loan. So how important is consistency with rate quoting and the pre-LE worksheet, and any do's and don'ts that you want to bring in from a compliance standpoint, and then we'll do a round with the mortgage professionals on the call.
Yeah, that's also a great question. A lot of this rule was designed to prevent the bait and switch. As you may have heard, the tolerance requirements are more stringent under this rule. There are triggers that would provide for an additional 3 business day waiting period if there are certain significant changes to the transaction. That does illustrate how important the CFPB views the prevention of bait and switch to consumers. And I think that if rate quoting on a worksheet and costs, and the quoting of cost estimates as well on a worksheet ends up becoming very different from what's on the LE that's provided to consumers, and that's for a high percentage of transactions, that could be something that raises the eyebrows of a regulator, because you can see from TRID that it was designed to prevent bait and switch, and that is something that, even if it's not expressly prohibited by the TRID rule, it is something that the Bureau would frown upon. And keep in mind, they still have their UDAP authority, which is authorities to prevent unfair, deceptive, or abusive acts or practices, and that's a very broad authority. So essentially, if they see something they don't like, they can issue an enforcement action against it. And so you can tell that they don't like bait and switch from the TRID rule. So I think it's better to be careful and try and avoid UDAP actions by having a pattern or practice of lowballing in your cost estimate.
Nice. Danny, what percentage of your families are getting that total cost experience, so that every time they're getting into a mortgage, they're getting the total cost and they're getting the the LE, and they're going through that consistent experience? What's that like in your platform?
100%. The total cost analysis is going out, every family buy-in and everyone refinancing.
Beautiful. That's right answer. Sean, in your platform and the way you coach mortgage professionals, what percentage of the families are getting that that mortgage coach educational experience on the front end?
It's 100%. It's just like Danny said, there's no time you wouldn't get it, and you're going to get it multiple times throughout the transaction. It's too easy of a tool to use, and it makes my job easier to educate. So I'm going to make my job as easy as I can.
And Dan, what percentage of your clients are getting that?
Every client that applies with me gets a total cost analysis worksheet.
So everybody on this call, you're a mortgage coach member. Make sure you're delivering that great experience to every family. Really can't push you enough around adding a video to that. The value is not just a sales value, it's an educational value. And I just want to remind everybody on the call, we've made that super simple for you just to go to your mobile app, log in, click 2 buttons, and you can add a video. And then, of course, you're going to continue to update that video. If you talk to them at pre-qual and now they put it into escrow, you might want to update the numbers, update the video. It's a great communication platform to help you collaborate with the family and the realtor. I also want to make sure everybody knows how to do the share. So, going into the Mortgage Coach mobile app, again, depending on what device you have, it may have a different way to share it. On the iPhone, which is most common, you click on your picture and your profile. It pulls up this virtual business card, this digital business card. You click on Share Report, and now you can email that or text that. Also in the back end of the platform, you can email that and share that. So I would just urge everybody, it's more important now than ever that you're able to share your total cost analysis with each and every family. If you're meeting with them in person, text it to them right when you're in front of them. And I hope my phone blows up. I put in my text number because I wanted to see how many Mortgage Coach professionals are using it. So that's my mobile number. Feel free to send me a share and share one of your TCAs, 949-370-7393. But this is just one of those things that going forward with TRID, we need to communicate, we need to deliver a better educational experience, and you need to do it more consistently than ever. So in this last 5 minutes, I just want to go around and make sure every loan officer gets to ask Rich any questions you want. Danny, do you have any questions for Rich that haven't been answered that you think would be valuable right now?
I think everything that was really top of mind for me was covered, and we really appreciate your time, Rich, coming out and helping us. And I think this is really, we're really in just the first few days of this, so I'm sure a lot more will come up as we actually are in the trenches experiencing it.
Dan Keller, any questions for Rich?
No, I don't. I appreciate Rich being a resource and being available. I think he covered everything that confirmed a lot of the things that we've already learned and are teaching. So thanks, Rich.
Yeah. Sean, any questions for Rich or any color or comments you want to cover before we wrap up?
I just wanted to thank Rich for kind of showing us the other side of how we got here, where we are, and like Dan said, I think the next month will be very telling. There's no way we've thought of every solution. So as things come up, it'll be great to share with the group and go from there.
Good. Well, Mortgage Coach community, we still have a few more minutes, but I want to keep submitting me your questions. As borrowers ask you questions, submit those to Mortgage Coach, or you can either add them to our social channel in comments, or you can email me, Dave at Mortgage Coach. What questions are families asking you? We want to bring leadership and value throughout the month. So let us know what questions are realtors asking. And Sean, I can't thank you enough for sharing this. You're always bringing your A game. And I think that's what mortgage professionals need to do. So Rich, when you think of some of the innovation that's taking place, obviously there's companies like us that are providing educational technology to help loan officers deliver a better educational experience. What do you see as trends that, new systems, new technologies that might be coming into the marketplace and might be more useful for the industry? Any thoughts or comments?
Yeah. So as you know, the new closing disclosure, which integrates the final till and the HUD-1 settlement statement, under TRID is the lender's document. So many lenders are deciding that they're going to prepare and send out the closing disclosure. But that closing disclosure will still need to contain a lot of information that comes from the settlement agent, the title company. And so there's a lot of technology that's being around getting that information from the settlement agent into the lender's systems to be able to place it on the closing disclosure and get it into the consumer's hands. Some of those are what are being called collaborative portals, such as DocMagic Smart Close system. I think that a lot of these systems will help lenders efficiently close loans so that there aren't delays when things change close to closing. Because if you don't have such a system, it's going to be potentially cumbersome to get information from the settlement agent back and forth between the title company and the lender to get into the lender system to get approved and then send it back to the title company to be able to give to the consumer at the closing table. To have a collaborative system might help save some of that time and potentially prevent delays in closing.
Love it. Love it. Well, Mortgage Coach members, I hope you got one of the takeaways is you just need to really think about your mission and vision. When I interviewed Kelly Zitlow a few weeks ago, she talked about her mission was to deliver honest, well-communicated, knowledge-based lending experience. She shared, a great little chart that she has. I have put that download in the handouts along with some of our TRID scripts. We will continue to be having these conversations. I do want to remind everybody this Wednesday we will be doing mobile training. So very specific. There's about 8 different ways that Mortgage Coach, whether it's creating TCAs, whether it's adding a video, whether it's having a mobile conversation with a borrower, whether it's sharing it, all the different ways that you can show, share, and create with Mortgage Coach. We will be showcasing this Wednesday and every Wednesday at 11 o'clock. Also want to remind you that we're going to be doing TRID training around how to use the technology and drive a better mortgage experience with TRID is here. And then I want to remind you guys, live next week from Sales Mastery, Sarah Middleton and myself will be, she'll be telling a very emotional story around how she's overcome adversity with leadership. And I do think it's a special call. Hopefully you'll tune in next week for Sarah. So folks, I think we are at the end of the time here. Rich, I hope you'll be available maybe again, between now and the next 30, 40 days to come back in, do a little Q&A. We'll talk about that offline. Danny, appreciate you. All the leaders on the call today, Sean and Dan, thanks for the time. Thanks for the leadership of the Mortgage Coach community. We are going to wrap it up, and everybody have a great day. One last thing, I am going to push a poll question. Let us know what you thought of today's call as you leave. And if you are a guest on this call and you want to learn more about Mortgage Coach or get a demo, just check that option. So again, let us know what you thought of today's call. Have a great week. Take care, everybody.